Every day, billions of dollars flow out of European banks and into India's government bond market. Recently, this pipeline of capital was nearly severed by a quiet regulatory war. On one side stood the Reserve Bank of India. It operates as the nation's central bank and the gatekeeper of the domestic financial system. On the other side was the European Securities and Markets Authority, or ESMA, enforcing a regional law known as EMIR, the European Market Infrastructure Regulation. This agency issued a strict ultimatum: allow European inspectors to directly audit the Indian computer systems handling these trades or face a financial blockade. For decades, the global financial dynamic followed a predictable pattern. When Western authorities demanded access or imposed new rules, developing nations opened their doors. Complying with foreign standards was simply the mandatory admission price to keep foreign investment flowing inward. But the Reserve Bank of India refused the inspection. This decision triggered a high-stakes standoff, threatening to lock European banks completely out of one of the fastest-growing markets on the planet. To understand exactly what the European Union wanted to control, you have to look at the financial plumbing. At the center of this dispute is the Clearing Corporation of India Limited, or CCIL. This domestic institution processes trillions of rupees in daily currency and government bond trades. This diagram shows a European bank on one side and an Indian bond seller on the other. When a bank wants to buy a bond, they don't simply hand over cash directly to the seller. The transaction routes through a central clearinghouse, which acts as a guarantor. Because this single choke point touches virtually every major trade, whoever monitors it effectively monitors the entire market. That is why European regulators demanded direct visibility. The Reserve Bank, however, viewed this as a security and legal risk. If they allowed European inspectors to bypass Indian laws and audit domestic clearinghouses, they would face identical demands from regulators in the United States and the United Kingdom. India viewed the demand for audits as a threat to its legal sovereignty. By rejecting the EU's terms, the RBI forced a confrontation over who truly controls the country's financial borders. In response to the refusal, European authorities launched a retaliatory strike. They officially de-recognized 6 major Indian clearinghouses. This penalty hit the exact entities that process trades for the Bombay Stock Exchange, as well as the National Stock Exchange. Overnight, the European Union legally invalidated the primary intermediaries handling India's equity and commodity markets. This graphic illustrates the impact on European bank profits. By stripping away recognition, the European Union legally forced its own banks to hold significantly more capital in reserve just to execute Indian trades. The compliance costs for European institutions skyrocketed. The European strategy relied on a massive assumption. They calculated that India would fold under the regulatory pressure to ensure European capital kept flowing into local markets. The Indian Central Bank held its ground, making a different calculation. They recognized that European investors actively needed access to Indian yields to generate returns. The regulators in Brussels actually had far less leverage than they thought. The standoff lasted for months. The European authorities finally blinked. The two sides signed a Memorandum of Understanding, where the European Securities and Markets Authority officially dropped its demand to directly supervise Indian clearinghouses. Instead of sending their own inspectors, Brussels agreed to rely entirely on the data and supervision provided exclusively by the Reserve Bank of India. By holding the line, the Reserve Bank protected the country's domestic financial architecture from foreign overreach. It proved that a developing economy could legally firewall its internal institutions from external mandates without losing access to foreign capital. The agreement provides a framework for other domestic regulators. Specialized hubs like Gift City, India's first international financial services center, can now cite this deal to secure their own jurisdictional independence from foreign oversight. For decades, Western regulators dictated policy to emerging markets by default. Now, large, rapidly growing economies are negotiating the rules of global finance on an equal footing with Western powers.